Something unusual just happened inside the United States financial system, and almost nobody noticed. A crypto company just connected directly to the Federal Reserve's payment infrastructure. That has never happened before. For decades, access to the Federal Reserve payment rails was limited to traditional banks, not fintech companies, not payment startups, and certainly not crypto companies, just banks. But that wall may have just started to crack, because a digital asset company has now gained access to something called a skinny master account at the Federal Reserve. And the company that just crossed that line is Kraken. Now, at first glance, that might sound like a boring piece of financial bureaucracy. But once you understand what this actually means, you start to realize something much bigger might be happening beneath the surface of the financial system. Because financial revolutions rarely begin with headlines. They begin with infrastructure. And infrastructure is exactly what just changed. To understand why this matters, we need to step back and look at how the global financial system actually works. Most retail investors spend their time watching price charts, green candles, red candles, short-term market movements. But institutions, the largest players in the world, are watching something completely different. They are watching financial plumbing, the pipes that move money across the system. And in the United States, those pipes are controlled by the Federal Reserve. At the center of this system are Federal Reserve master accounts. If a financial institution has a master account with the Fed, it can directly access the core payment rails of the United States financial system. These rails include systems like FedWire, FedNow, and the National Settlement Service. Every single day, trillions of dollars move through these systems. Banks settle transactions, clear payments, move liquidity between institutions, and manage the flow of capital throughout the economy. Historically, access to these systems has been extremely restricted. Only regulated banks were allowed inside. Everyone else, fintech companies, payment platforms, and crypto businesses, had to operate outside the system. If they wanted to move US dollars, they needed to partner with a bank that already had access. That created friction. It created delays. And it created dependency on traditional financial institutions. But Kraken's new approval changes that dynamic in a very important way. Through a special regulatory structure created in the state of Wyoming, known as a Special Purpose Depository Institution, or SPDI, Kraken was able to apply for a form of Federal Reserve access, and what they received is called a skinny master account. Now, this is not the same thing as a full Federal Reserve master account. It comes with limitations. For example, Kraken cannot earn interest on funds held at the Fed. They cannot borrow money from the Federal Reserve's discount window. They cannot settle payments on behalf of other financial institutions. And they cannot operate like a traditional correspondent bank. But despite those restrictions, something very important just happened. Kraken can now directly clear and settle its own payments using Federal Reserve payment rails. Think about that for a moment. For the first time in history, a digital asset company is plugged directly into the same financial infrastructure used by traditional banks. That's not just a small regulatory change, that's a structural shift. Because once the door opens for one company, it becomes much easier for others to follow. And this is where things start getting even more interesting. Because Kraken might be the first, but it almost certainly won't be the last. Reports earlier this year indicated that Ripple applied for a Federal Reserve master account as well. And if Ripple were eventually granted access, even a limited version like Kraken's, it could dramatically change their role inside the financial system. Right now, Ripple works primarily by connecting banks together through blockchain infrastructure. Banks hold the fiat currency. Ripple's technology facilitates the movement and settlement of value between them. But if Ripple gained direct access to the Federal Reserve payment rails, they would no longer be sitting outside the system. They would be operating side by side with banks. And that difference might sound small, but in financial infrastructure terms, it's enormous. Because removing layers reduces friction, and reducing friction is exactly how financial systems evolve. Now, to really understand why companies like Ripple are focused on this infrastructure, we need to talk about one of the biggest inefficiencies in global finance: cross-border payments. Every year, more than $150 trillion moves across international borders. Banks exchange currencies. Companies pay suppliers. Governments move capital. But the system that supports these payments is surprisingly inefficient. Banks around the world maintain something called Nostro and Vostro accounts. These are pre-funded accounts that banks hold in foreign countries. If a US bank wants to send money to Europe, it may need to hold liquidity inside a European bank ahead of time. That money just sits there, waiting, unused. Estimates suggest that as much as $27 trillion globally may be locked inside these dormant liquidity pools. $27 trillion in capital that could otherwise be circulating through the global economy. Instead, it remains frozen in place to support the settlement of international payments. This is exactly the inefficiency that blockchain-based financial systems are attempting to solve. Instead of pre-funding accounts around the world, liquidity can be sourced on demand. Transactions can settle almost instantly, and capital no longer needs to remain trapped in dormant accounts. This concept is at the heart of Ripple's on-demand liquidity system, which uses the XRP Ledger as a bridge for transferring value between different currencies. Now here's where the conversation around XRP becomes interesting. Many people focus only on price speculation, but large institutions focus on liquidity mechanics. If large amounts of value need to move through a digital asset, the asset must be capable of supporting those transfers efficiently. XRP has a maximum supply of 100 billion tokens, but the effective circulating supply is smaller. Some tokens remain locked in escrow. Some are held long-term. Some have been lost permanently. If large financial flows begin using digital bridge assets for settlement, the asset price must eventually adjust to support efficient liquidity. Higher prices allow larger transfers using fewer tokens. That reduces slippage, improves market efficiency, and allows institutions to move significant value through the network. This isn't speculation, it's basic financial mathematics, and institutions understand this very well. But infrastructure adoption isn't happening only inside banking systems. We're also seeing blockchain networks expand into entirely new industries. One recent example involves the maritime trade finance sector. Through a platform known as C-Link Finance, the XRP Ledger is being used to support financing for global shipping routes. The maritime trade industry alone is estimated to be worth around $2 trillion. Every day, ships transport energy resources, raw materials, and manufactured goods across the world's oceans. These voyages require financing. Investors fund shipments. Companies issue invoices. Cargo progress must be tracked. Payments must be distributed once goods arrive. Traditionally, this process has been slow and heavily dependent on paperwork. Blockchain infrastructure introduces automation. Invoices can be generated digitally. Cargo progress can be tracked in real time. Investor payouts can be distributed automatically through smart systems. And the transaction layer powering these operations can run on blockchain networks like the XRP Ledger. While many retail traders focus on daily market volatility, infrastructure continues expanding quietly in the background. And there is one final piece of the puzzle that could accelerate everything we've discussed: regulation. For years, institutional capital has remained cautious about entering crypto markets due to legal uncertainty. Large asset managers cannot deploy billions of dollars into markets that lack clear regulatory frameworks. But in the United States, lawmakers are currently working on legislation designed to clarify the structure of digital asset markets. Two major proposals are receiving significant attention: the Genius Act and the Digital Asset Market Clarity Act. These bills aim to define which digital assets are securities, which function as commodities, and how stablecoins should operate within the financial system. Once regulatory clarity appears, a major barrier to institutional adoption disappears. And when risk decreases, capital begins to move. That's how financial systems evolve. Infrastructure comes first, regulation follows, adoption begins, and price eventually reflects the new reality. So when we step back and look at the bigger picture, the signals are becoming increasingly difficult to ignore. A crypto company now has direct access to Federal Reserve payment rails. Ripple may be waiting in line for similar integration. Blockchain networks are expanding into global trade industries. Institutional investment products are slowly attracting capital, and governments are moving closer to defining the rules that will govern the digital asset economy. That's not chaos, that's construction. Price is noise. Infrastructure is signal. And the real question investors should be asking right now is simple. Are you watching the daily volatility of the market? Or are you watching the architecture of the next financial system being built in real time? Because history rarely rewards those who follow the crowd. It rewards the people who recognize change before everyone else does. And right now, the foundation of the financial system may already be starting to shift. But here's the question I want to leave you with. If companies like Kraken and possibly Ripple are beginning to connect directly to the core infrastructure of the financial system, what do you think that could mean for the future of crypto and for XRP? Let me know what you think.